we started to talk about that you worked for the French Warren Buffett. That's a pretty big headline. Can you give us a little insight on who he was and what that meant?
He's pretty much retired now, but he followed Benjamin Graham, Warren Buffett. But his twist on things was back then he had a global spin on things. So Warren Buffett tends to be U.S. centric for the most part, especially in his early career. And what he did was, what was interesting about his background was because he was a European and he was managing a U.S. fund, we were a global value fund. So we took Warren Buffett and Benjamin Graham's philosophy of value driven and we spun it into the whole world. So we were a go anywhere fund.
You just gave away the entire secret to trading right there.
Yeah.
Work your way into positions, manage the downside, and eventually learn how and when to trade bigger or hold longer.
And the money shows up. You know what I mean? Like the money's a byproduct of all that. Like you can't focus on the money.
Hey, John, good morning. How's it going?
Good morning, Pete. And good morning, everybody.
Good morning. Good morning, everybody. Thank you for joining us this morning. So all the focus on Jerome Powell this week, and he spent a lot of time not talking about inflation, a lot of time talking about jobs. How do we interpret that?
Well, I think that's the cause of worry now that inflation is quote unquote under control, or at least he thinks it is. That's going to be the next side of the equation, right? So I think he just wants to manage expectations. But I think the real story was the minutes of the meeting. It looks like on Wednesday, there were some people, I guess some of the Fed governors wanted to cut rates in July, which doesn't surprise me. I thought a July cut would have been better only because it's further away from the election and you have that extra couple of months to see what happens. You know what I mean?
Yeah.
But he decided to be conservative and wait. But I think he got some pushback there and it looked like there might have been a little wrangling going on. So I think that was the reason why I think he really wanted to be vocal when he kind of mentioned, hey, the time has come. I think he wanted to kind of message his team also, not just the whole world. So that was my take on it. But I think now focusing more on employment makes sense because, if at least for now, inflation seems under control.
So I'm going to hit you with a stat. Obviously, we have more economic data coming out this week, which is we have GDP and PCE, which are two of the three, trinity of looking at economic data. And they're kind of like an afterthought now at this point where he basically said we're definitely cutting. So there's not going to be as much pressure on either swing trades or anything along those lines with this big economic data coming out this week, unless they shock in one direction or the other. But I don't see that happening with all the emphasis on. He's already saying he's going to cut.
I think, from from just looking at the Fed fund futures and everything like that, again, the market does tend to get ahead of their skis on occasion. And I think that now they're pricing in a 1% cut, throughout the end of the year. So that's pretty substantial. And what that tells me as a trader, when you're anticipating 1% over the next, let's say 6 months, right? That tells me that any kind of, let's just call it really hot data that comes out, if it like good, meaning hot, like not hot unemployment, but like hot economic data, right? If it comes in too hot, I think the markets might retreat because now they're expecting more cuts. It's almost like the market gets kind of like in a frenzy over cuts now. And then if it disappoints, if they get a little bit ahead of their skis, and there becomes this, hot data that comes out, that could cause a little bit of a market stir as we go into one of the most volatile time periods in the calendar, which is the first September into October 15th. So it's something to keep in mind as well.
Yeah, throw the election on top of that, and everybody promising the moon and everything you could imagine at this point. It's going to be a Q4 that you're really going to have to be on top of your game planning. I don't think it's going to be the same way it was in Q1 and Q2, where you can basically just sit back, say everything's going up, and you're just going to place a trade and not look at your account for a couple of weeks. That's not what we're heading into for Q4.
Yeah, it's interesting. They do tend to make those promises, both sides. Going into the election, obviously both sides want to win, right? So they're going to start. There'll be some volatility just with the policy that comes out. You know what I mean? That'll be it as well. The good news is everyone who works in service is not going to get taxed. That's good news. right? With tips.
Yeah.
So no matter what side you're on, you know, you're gonna if you're in the service industry, you might get yourself a tax break, which is nice. That's encouraging. But you know, there's a lot of other stuff going on too. You have a lot of stuff. You know, there's a lot of stuff going on in Europe. There's a lot of stuff going on in, you know, geopolitical wise, Venezuela, obviously. You know, as a global trader formally, I do kind of take a peek at what's going on around the world. And, you know, things aren't that great. You still have 2 wars going on. You still have any one of these little things can kind of bubble over. You know what I mean?
Ukraine actually getting into Russia, that's a big deal.
Yeah, you have to kind of just be aware of what's going on. Obviously, you can't predict the future, and geopolitical is probably the biggest unpredictable event you could probably, you know, try to predict. You know what I mean? So with the peace talks in the Middle East, if that works out, that would be great. But yeah, also Ukraine versus Russia, some sort of resolution at some point, it would be nice. But yeah, you just don't know. So those are the kind of unknowns you can't really control, which is why you have to keep trading what's in front of you. If you worried about every single, you know, I think if my mother was a trader, she would probably never place a single order because she's always worried about what's going on in the world, right? So if you're a news junkie, if you're always kind of watching the news and so nervous about what's going on, yeah, there are some things that aren't that pretty that's going on, but you have to keep on moving. You know, the world keeps turning. You know,
I personally always found it hard to trade the news. When I first started trading back in 2000, it was very common to have something happen on CNBC or, you know, some sort of news. If you had I guess back then, instant was like you got it within 10 minutes, and now it's within 10 seconds. I always found it very difficult to get involved in that right away and read what was going on. I couldn't do it. Some people had the knack for it, but I just didn't do it. It was too unpredictable for me.
Too unpredictable, and now it's impossible because of all the computers and all the algorithms and stuff like that. And it's just, yeah, I never was a big fan of that. I think, you know, if you just look at history, there's great books. I mean, I love Market Wizards. All those books are great. They talk. I mean, if you just follow what some of these top traders have done over there, and we're going back 100 years in some cases, like with Jesse Livermore and, you know, others, they were trend followers. You know what I mean? And once in a while, they would take a big bet, but they would start small and they would try to get some proof. And then they would add to their good bets and they would take away their bad bets. And if you read those Market Wizard books or any of those kind of trading books, it's always the same kind of narrative. They know how to manage the downside. That's like the number one lesson you could always learn from these people. And they also knew when to put on risk. That's like the winning combination. If you want to kind of simplify what we do, that's it.
You just gave away the entire secret to trading right there.
Yeah.
Work your way into positions, manage the downside, and eventually learn how and when to trade bigger or hold longer.
And the money shows up. You know what I mean? Like the money's a byproduct of all that. Like you can't focus on the money shows up. And I
think that does also highlight 2 big problems for people is they trade too big. They trade too big relative to their trading account, and they trade too big relative to their profitable track record, meaning they don't have a profitable track record to justify it.
Yeah.
And not taking losses. I think those 2 simple things can turn around a lot of trading accounts if you really think it through.
Yeah, and I think part of the reason why people don't take losses is because they're trying to trade to make their rent, and that's not good either. You know, it's very stressful if you don't have cushion. You know what I mean? And you're trying to make your monthly expenses with trading revenue. You kind of have to take a broader aspect when you do that. If you trade professionally for a living, if you do it as your full-time job, you know, you have to have some sort of a backstop, and you kind of have to look at your whole year's performance. You can't worry about month to month because the stock market doesn't care that you have to make your rent this month. Like the stock market comes in cycles. And those cycles might be 6 months. They might be 1 month. You know, you might get a correction in 1 month, and then the market might steadily increase. You might make all your money in 1 month and have like 5 losing months. You might have a very choppy year, in other words.
A lot of people can't mentally handle that.
Yeah, you have to just kind of take a step back and look. Not one single trade should matter. I always say that to people. I always say that to the community. And if you go to sleep at night and you're thinking about a trade, it's probably too big, either one way or another. And that's kind of what you have to kind of ingrain in yourself.
The reality of trading is that trading is a business, and very, very rarely will you just open your business like that and start being profitable, and especially where you could turn your life upside down. When I had my firm, I went through this conversation, literally, not even figuratively, thousands of times, of people wanting to quit their job and become a full-time trader. And I was very honest with people because, look, I mean, you're talking about messing with somebody's life. I never wanted to tell them what I thought they wanted to hear. And I would say, don't even think about it until you have at least 6 months of profitability, at least 6 months of profitability. It not only covers what you're making now as an income, but also covers your health benefits, because you're going to leave that job and now you're responsible for your family's health benefits. When you have 6 months where you can cover that through different types of market conditions, then you can even think about it.
Right.
And that doesn't even mean just go and do it. But that's the I don't want to use the word advice because that's not the right word, especially in our industry. But that was the experience that I gave people, because most people come into the industry and they have this clock in their head that said, okay, I got a certain amount of money in the bank that's going to last me 4 months. In their mind, they're going to just start making money and replace their entire livelihood inside of 4 months. And then the problem is, right out of the gate, they're trying to make money as opposed to trying to learn how to be a trader.
Right.
They're not doing the little things that add up to profitability, which is journaling, paying attention to what's working, paying attention to whether or not you're following it. And they're only judging every single day based on whether or not they made money and not whether or not they were actually improving, which is a big difference, because you can make money on bad ideas and justify that you know what you're doing. And you need repeatability.
That's almost one of the worst things that could happen to a new trader, is actually success. Like if they
quick success, absolutely.
If they have success and they don't know why they're successful, that's a problem. If it's not, they just got lucky. And if they get lucky, I mean, again, the market doesn't care. The market goes up and down, does what it does. So you can get lucky. You could have one fantastic month because you picked really good stuff and just happened to be at the right place at the right time. Just like you could be the worst place the worst time. So that would be the worst case scenario. I joke around. On my 21st birthday, my friends took me to Atlantic City, right? And I went there and I played craps for the first time, and I won like $500. And I was like, "Oh, this is easy. All you have to do is roll dice. I mean, come on. How hard was this game?" I came back with $500. I actually didn't give it back. I won, right? And my father looked at me and he said, "John, that is the worst thing that could have ever happened to you." And I didn't know what he meant at the time, but then I realized very quickly what he meant, because I didn't know why I won. I didn't know what was going on. I was just blindly throwing dice, just similar to trading when you're new and you don't realize why you're winning. Like, so you're not journaling. That's so important to journal.
Yeah.
You're winning.
I would say, throwing a number out there, I would say 90% of the people that trade don't keep a journal. Oh
man, I would say, yeah, I agree. I think so. And it doesn't have to be fancy. You know what I mean? It could just be like a book, literally. You know what I mean? If you're more organized, you could have an Excel spreadsheet. You know what I mean? And, the key things to journaling, I think, is, what type of trade was it? What side was it on? What sector? What was the market sentiment at the time? And then you could write down your emotions, or you write down why you exited, why you got in, why you got out. But the more specific you are, I like Excel. I like doing it on Excel because then you can sort things and you could create a little bit of data, you know what I mean? Mm-hmm. And try to figure out, well, it looks like all of my credit spreads didn't work this month. Why? You know what I mean? For options traders, especially, because there's so many different styles. So it's important to have like a little bit of a spreadsheet,
I think traders would be shocked if they do some detailed analysis of where they're actually making money versus where they think they're making money. Long versus short, sector specific, what stocks they're making or losing money in. That's real data. We can tend to feel like we enjoy trading certain stocks, but then when you actually go into the data and determine whether or not you're actually making money, I think traders would really be in for a surprise to see where the P&L is actually coming or going.
Yeah, absolutely. And you know what's funny? This actually came up on the recap on Thursday when I gave the recap. One of the things, when I first started journaling, I noticed that my short trades, my put options, my short positions were underperforming. Like I just either got stopped out too fast, or I didn't have as much of a winning percentage with my put options as I did my call options. And I couldn't figure out why. I was like, I'm going through the same process. I look at charts, I'm looking at sectors, I'm doing everything right. I have my risk management in place, blah, 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 right? And I realized that the market doesn't treat ups as fast as they do downs, like in general. If you look at a stock chart, charts tend to go up slowly, right? Unless there's news, but as a general rule, stocks tend to kind of grind higher. So when you're doing a call option, you need a little bit of time for the trade to work, right? Because it might base for a little while, it might go sideways for a little while. And then on the short side, that's not the case, right? When something's going down, it tends to go down hard and fast. And if you catch it right, you have to catch it fast. Usually, I mean, there are the slow march of death. There are some stock charts that just kind of drift down slowly. But what I did was I started to tweak my put options a little bit. I made them a little bit more shorter dated. I took profits faster, and then I realized, and this is important from journaling, I realized this, that my puts were not. That I had to kind of tweak my strategy a little bit. And that's one of the things, that's one of the things I learned from journaling personally,
Do you, with that in mind, expecting it to go down faster, do you have a quicker trigger on I'm just going to use in general terms here, if you're buying puts or betting on a move to the downside versus knowing that it takes a little longer and it's a grind to the upside? Do you have a quicker trigger on trades that aren't moving fast enough on the short side?
A quicker trigger,
to get out of them.
Not to get out of them, but I have a quicker trigger to get out of them when they're profitable.
Oh, interesting.
So in other words, if they're basing, it's still a theta negative trade, whether it's a put or a call, right? So it's a time sensitive trade because obviously no matter whether you buy a call or a put, you have time decay, right? So I always put a spread together to be theta positive. Now, if it's a straight put, the answer is yes. If
that's actually two different answers then, because I was asking it just from a straight up buying a put, but putting the spread on, obviously it gives you more options.
Yeah, no pun intended. Yeah. So if you have a vertical or a diagonal, I have no problem sitting through a low base, thinking it might break down, no problem, right? But if it's a straight put that I thought it was going to just collapse and it's not collapsing, I don't want time to tick away and just lose money. So I would be quick to say my edge is gone then.
So you mentioned Market Wizards before, and I just happened to be on YouTube yesterday looking for something, and there was an interview with somebody who was in the first Market Wizards book or the second one. I forgot which one. I think it was the first one. And the guy basically said every trade he puts on, he takes off 3/4 of his position when he hits 1-to-1 risk reward.
Wow.
I thought that was rather aggressive.
Yeah, I mean, I think it's just that's his risk management strategy. You know what I mean? And he probably figures, hey, listen, if this thing exceeds my expectations, I still have most of my trade on.
No, he's taking off 3/4 of it.
Oh, he takes off 3/4. Oh, so he only leaves a piece on.
Yeah, that's why I thought it was strange.
That's pretty conservative.
Yeah.
But I think it also depends what vehicle you trade. You know what I mean? Like you have to kind of, is he trading futures? Is he trading?
I think he's trading futures.
Yeah, I mean, futures tend to move faster, so that could be the reason.
Getting out while it's there.
It definitely depends on, and he might be taking huge size. So he might be looking for like a small gain and then take the risk off and just leave a little tail on in case something.
So that actually brings up something really important is how you get to that position concentration. Like you could start out with a much bigger initial position, knowing you're not going to be in it long. You just kind of like, which is really a lot of what day traders or swing traders who get in today and get out tomorrow, that's their entire strategy.
Yeah.
But I want to be clear to everybody, there's two different ways to get size. Number one is on a shorter time frame where you're managing risk. And the other one is what you actually mentioned at the start of today's call, which is building your way into that, which is what a lot of those classic traders did. They didn't take size. Quite frankly, the market couldn't handle size.
Yeah, back then, especially, absolutely. It was one of those things where it was, back then the spreads were so wide and it was just the wild, wild west, especially in some of these futures markets.
So I got another question for you. Good question that recently got brought up. Are we trading the market or are we trading the stock?
That's a great question. My answer would be both. Right?
Would you give a percentage on that?
Well, I have my 80-20, my 60-20-20 rule. So 60% of any stock's movement on any given day. Now, this has nothing to do with news or any kind of weird. I'm talking about a typical day, right? Typical trading day, no earnings, no news, nothing going on. 60% of the movement of that stock has to do with the market itself. The other 20% has to do with the sector that it's in. And the other 20%, stock picking does matter. So you want to pick the best of the best of the worst of the worst. So 20% matters too. So the answer is it depends how short term you are. You know what I mean? So if you're a swing trader, you're paying more attention to the stock chart itself, because even if the market goes down for a couple of days, your stock might outperform and you might get lucky and it might not go down as much, right? If you're picking the right stock.
I think that's really where the context of where the question came from, because he was pointing out a stock that rallied while the market wasn't doing anything. And he's like, why do I watch the market if this thing just went up 10%? Well, I think it's more complicated than just that individual trade idea, but I think it's worth the other discussion.
Well, it's probably news, or there might have been a sector rotation or something like that. So it could have been a specific reason. But if you're a day trader, and the markets look soft, you should not be going full on long that day. You know what I mean? Because chances are you're gonna, your stock just might not do much. You know what I mean? So, that's why day trading could be a little bit challenging in the sense that you do have to pay more attention to market dynamics, what's going on that day. You know what I mean? What type of events are occurring that could cause a reversal, stuff like that. There's basically, to simplify things, if you're day trading, and this is how when I did do day trading, I worked on a prop desk as well for a little while. You got to look at the market as you either have a trend day where the market just, the futures are up and they stay up all day and they just trend higher all day. That's a trend day, right? Or the other way, down, right? Then you have some days you have a reversal day. You might get a gap up and then the market just fades the rest of the day, right? Or vice versa. And then you get a choppy day. And unfortunately, those choppy days you could have a choppy day, you could have a choppy week. You know what I mean? So you have to really know what the market's doing and what's going on if you're short-term trading. And then you got to focus on your individual names, what's hot that day, what sectors are hot, where's the institutional flow going, why is it moving, what's going on this week? Is it earnings? Is it not earnings? There's a lot of factors there. But when you're swing trading, the market and sector are important. You want to know where the order flow is going, right? But then individual picking makes a difference, because you want to find outperformers or underperformers. So it really depends.
Yeah, actually, what you just mentioned on the day trading side of things, that's why we spend so much time. We actually have what we call minimum viable criteria.
Yeah.
And day trading is completely different from any other animal, because you could have a monster trend day that if you have your metrics in place or your reference points in place, you could take advantage of that regardless of what's going on in the bigger picture. And that's not really the challenge, I think, for most people. I think the challenge is when everything does line up, you don't make enough in that direction.
Yeah, it could be pretty frustrating. But it could, then unfortunately, you have single stock risk. Something could be going on that day with the individual stock. So from a swing perspective, you do still have to pay attention to market sentiment. You got to know what trend the overall market is in. So this way, you know how to allocate capital. When I think of it in terms of always as a basket, I always talk about this. So so to me, one trade does not matter, right? I have a basket of, let's say 10, 20, 30 things. And how do I present my basket optimally to the market? Like, is sentiment an A+ or a B+ or a B- or what's going on? That'll determine my basket size, how many bulls I have, how many bears I have, how many sideways I have. And then
you have two different layers of, okay, bullish versus bearish. That's one layer. And then does that also then affect allocation? So in other words, 70-30 bullish, then how do you determine your allocation on the 70-30 from a percentage of capital?
So if I'm 70-30 bullish, then I go down to the sectors and say, well, if let's say I feel like I'm not bullish enough. Let's say I have too many bears for whatever reason. Maybe I took profits. Maybe I have some open spots, let's call it, right? I have open spots in my basket. Then I go down to the sector and I say, well, okay, the sector that outperformed the best last week, like basic materials, for instance, had a nice little rally this week. So that would be an area where I would start to look. And I would look to add to my basket because, hey, I have some financials, I have an industrial, I have technology. Now I need to add basic materials because they finally decided to show a little bit of strength this week. So that's kind of how I think. Same thing on the reverse side when I want to unload or when I want to maybe get more bearish. I do the same thing. Now, sometimes things move really fast. So let's say I'm in the market, I have my basket, everything's hunky dory, and the market rolls over, right? So obviously I'll get stopped out naturally. I'll get stopped out of some of my long positions. It'll just happen, or my edge might be lost on some of them, so I'll reduce manually. But then what I'll do is, if I don't have time to search through, do a screener or what have you, I might have a list of bearish trades, which I'll try to add. But if I don't have time to do that, I'll do a hedge. So I'll do like QQQ puts, SPY puts, just to offset the existing bulls that I have without taking them off. Because what if the market reverses again? You know what I mean? I'm not going to keep getting shaking out. So I use hedging so I don't get shaken out of good trades. If that makes sense.
So we've had market breadth improve a little bit the last couple of weeks. The amount of stocks that turned around, dramatic difference, where we went from bearish to neutral to 2 pretty solid weeks. And this looks great, but then you kind of dive a little bit more into the S&P, and I think we're cooling off a little bit. I think the market's really trying to decide right now, are we going to actually hit new all-time highs? Like, is everything that awesome right now that the SPY is actually going to hit new all-time highs? The Dow and the NASDAQ aren't as close, but the SPY is. And I think the SPY is probably benefiting a little bit more from the large cap stocks that caught a bid again.
Yeah, they definitely did. And it's nice to see the weekly heat map that you showed. It's nice to see that there's breadth in the market, right? That's the most important thing for the S&P, to see some new leadership. And, it's actually healthy to see Microsoft and the others be a little bit softer. They weren't down necessarily, but they were underperforming. You know what I mean? And it's good to see that money is staying in the market and not moving out of the market. And that's the key difference. So do I think I think the closer we stay, we stayed above that 50-day moving average for a long time. That made me more bullish last week. And now the next step is to see if we could get to new highs. We'll probably pull back before then, just because of seasonally where we are, and there's not much going on. So I would anticipate some sort of a pullback, like we kind of got on Thursday. But I think Powell's comments just kind of eradicated any type of pullback that the market wanted to give. I think if Powell didn't make those comments on Friday, whatever it was, you could see Thursday's candle it was trying to find its way back to the moving average. So I don't think Powell did it on purpose, but he kind of poo-pooed the whole pullback, which I was hoping I could buy into, but I didn't have a chance to.
Yeah.
But that might happen next week, because it'll be slow. It'll be pretty quiet.
Yeah, that's something everybody needs to be aware of with Labor Day weekend coming up. That's going to be volume is going to be off next week, for lack of a better way of putting it.
Yeah, I mean, I think now we'll probably base, maybe drift higher. I just don't feel the sentiment is negative enough to pull back unless data comes out a little bit soft or what have you. You know what I mean? But either way, I would, as a general rule, any pullback, I'll say the same thing I said last week. Like, if there is a pullback, I'd be a buyer, only because we already had our corrective action a couple of weeks ago. I know calendar-wise, historically, September, October tend to be really volatile. The last couple of years, that's held true. We've had some real volatility in October and September even. And that could keep going. That could happen again. But the only but I'm going to say is that we already had our corrective action. We already had a corrective action a couple of weeks ago. So that might allow us to survive September and October. You know what I mean? So
almost a 10% move to the downside,
which didn't happen in previous years. So, the market was waiting to have that pullback in previous years. So since we already had it, I guess what I'm trying to say is we might not get it again like we usually do from a calendar perspective. It came a little early this year. That doesn't mean it can't happen again. But I think that overall things look like fairly positive right now. Sentiment shifted back to positive.
So I'm going to hit you with a different question. Can stocks get a little bit to the point where there's no buyers left? And I'll give you an example. This particular scan and metric that I run for the community every day is over a 5-day period. So it's a rolling 5-day period measuring the percentage of stocks positive versus negative. And the darker green or darker red represents higher than 75%. So I'm kind of distinguishing between it was green in that sector over 5 days, and then it's really green, right? So we've had a lot of really green, and maintain that bid. And I want to kind of like really emphasize this like in a much bigger way and get your take on the question I'm about to ask. Friday. So the one I just showed is the 5-day metric. And I kind of run one on the side that I'm testing right now, which is a daily metric, which I think can be very erratic because, from one day to the next.
Yeah.
However, real estate and energy had 100% of the stocks positive on Friday.
On Friday.
Wow. 100%. I don't know that. I think maybe in utilities once or twice this year I saw 100%, but that's the first time I saw two sectors at the same time on a particular day, 100%.
Yeah, I mean, real estate sort of makes sense, but energy is one of those weird ones. You know what I mean?
Yeah.
Again, I think energy might be getting ahead of itself a little. I actually have a short energy position, XL and XLE, because I think it just the chart looked like a longer term downtrend. You know what I mean? The chart looks like, it's almost doing a little bit of a bear rally, if you can see. Like, as long as it stays below those moving averages, it had a really good day, like you said, on Friday, but it's still, the chart does not look impressive compared to the other sector charts. If you pull up any other sector, this is clearly the most underperforming sector in the last couple of weeks, if you look at the overall trend.
We've had some really good trades here. You and I have been talking about this since the breakout at 148.
Yeah. But, as far as energy goes, I think it's interesting that there was so much cohesion, you know what I mean, with all the different positive names. That could just be, some hopes that maybe there'll be a ceasefire. It could be geopolitical related. And that's where trading gets tough, because when you start trading around news, like you said earlier, it gets a little bit tricky. That's the only reason why I could kind of understand why people are just trying to get ahead of the news. I know, I think Hamas went to Egypt over the weekend to discuss the ceasefire or something like that. So there is some stuff going on behind the scenes right now.
Yeah. So like I said, energy 100% on Friday and real estate 100%. Now, real estate, it kind of makes sense with the way the conversation around interest rates is going. The housing market itself is not exactly doing fantastic right now. And there's a bigger picture problem there with everybody who locked in interest rates between 2% and 3.5%. Why in the world would you be looking to get rid of that property? I mean, you basically borrowed at 30 years for nothing.
Yeah. The only exception to that would be if you paid your house off and now you could take all that money and just lump down cash on something and not have to worry about a mortgage. But there's very few people in that position. So,
yeah.
I don't think that's the case. I think it's getting more and more difficult to buy a home, especially for, Gen Z and younger millennials. You know what I mean? It's getting very tough. So I don't think
a lot of us are living at home.
Yeah, it's definitely true. I think living at home has been my generation. People would make fun of me if I lived at home. It was like,
I moved out when I was 17 and I never looked back.
Yeah, my parents had a basement apartment. And I had my own entrance. I had my own thing going on. You know what I mean? My friends still made fun of me. Like, oh, you live with your mommy and daddy. And in the meantime, I was saving money on rent. I was going to the Hamptons every weekend because I had money. I was able to save on rent and just go travel and do stuff. So I was like, I was kind of mad when my friends would make fun of me. But then I realized, hey, listen, I got to get out of here. And I did. But now I think there's no stigma. You know what I mean? There's very little stigma for you to stay with your family and live and save money. You know what I mean? Yeah. So I would recommend doing that if you're young and you're listening to this.
The key is to save the money though, and not go out to the Hamptons and
don't go out. Yeah, don't do what I did and blow most of it on on going out. But yeah, so that's the drawdown there, because if you do save, you have to have the discipline to save, right? So I saved some, so it was okay. But
next week's trading is going to be a little bit weird, for lack of a better way of putting it. We do have a 3-day weekend coming up.
Yep.
But we also have, like we talked about, we do have some economic data, and NVIDIA's reporting. That's no slouch. I mean, that's probably one of the biggest stocks in the market right now. So I guess what I'm saying to everybody is don't write off next week.
Yeah.
There's going to be opportunity. Don't go into, because we used to have people all the time say, oh, nothing's going to happen. It's heading into the holiday. And everybody thinks this magic faucet's going to get turned on with volume as soon as everybody comes back from Labor Day weekend. There's stuff going on this week. 2 big economic reports, and NVIDIA's reporting. There's going to be tradable opportunities.
So NVIDIA, the option market, last time I checked, was pricing in a 12% move.
12%. So now what is it, $130 or something like that right now?
Yeah. So it was
128.
yeah, so a 12% swing in either direction. So I think that's probably why you saw, even though Microsoft and those big names were not down on the week, they weren't performing as well, because I think people are waiting. I think there is, in the tech space, I think there's, it used to be Apple, right? Now it's like now NVIDIA seems to be like the one everybody watches. So that's going to be a big one, like you said.
It looks like roughly a $15 move.
Yep. So that's your range. That's what the options market's telling us within one standard deviation.
So NVIDIA is scheduled. I was up to scheduled for after hours on Wednesday, and then the economic stuff that we have going on. GDP coming out on Thursday, obviously pre-market, and then core PCE, which is the main Fed inflation number, coming out on Friday morning as well. So we got Wednesday night, Thursday, and Friday, 3 big events unfolding to keep the volatility going into the weekend.
The implied volatility on NVIDIA is 103%.
Wow.
That's up there.
So what does that mean from an options buying versus options selling perspective?
Well, it means you need to be right if you're going to be a buyer.
Massively right.
So let's pretend let's say you're bullish on NVIDIA right here, and you buy the August 30 call options that are at the money. You're going to spend $7 or $700, right? So it's $725 by $735. So let's call it $7 to make the math easy. Yeah, you are right though. It is, if you add up the puts and the calls, it's about a $15 move. You kind of nailed it. It's about $15 in either direction. So a $7 move, your break even is 129 plus 725. So that's why 136 and a half ish, 136.25. That's for you to make any money whatsoever. It has to get there. So that's all smoke and mirrors. That whole $7 is something called extrinsic value. And extrinsic value is basically time and volatility. That's the speculative part of an option. So that's $7 that has to move for you to break even. That's a lot. That's a big ask, And even if it does move, think about this: you're risking the whole 700, because if the market was to roll over, if NVIDIA rolled, you lose the whole 700, because that's the 6-day option. You only have 6 days to recover. So chances are, if NVIDIA was to fall, you're not going to make that money back. So you're risking essentially $700, and you're breaking per contract, and you're just think of the risk for a second here. Now, in order for you to make any money whatsoever, if you're going to make $1, it's got to go to 137. Right. So why would you risk 700 to make $1? So you really have to. So my point is, you have to really expect an outsized move in order to profit from something like that. And just by looking at those break even numbers, a lot of new traders don't sit there and go through that exercise, and they just think, oh, I'm just going to buy some call options and I'm going to make 200%. That's not, it's harder to do when you get those implied volatility numbers like that.
So we did have I have found this quarter, the biggest trades that have been reliable have been earnings plays, ones that have caught a bid and taken off. Probably one of the bigger trades this week was Zoom, believe it or not.
Yeah.
Two amazing days. You could have taken advantage of as either a day trader or a swing trader, probably on the day trading side of things. The challenge now, obviously, this is way beyond what we would call an optimal entry. It's also heading into resistance.
Yep.
May get what we call one more day, which we call a bullish echo, which is that last bit of people getting in there late, but not necessarily something to start a new swing on. But you got a game plan for this. You got to be like, okay, this thing was amazing. I need for it to pause before I look for a new entry. And we kind of got one in a stock that's been kind of dormant for a while that just really woke up in a big way and finally took out this resistance that hasn't been able to break through almost for the entire year. Really just going all the way back into February. That has my attention this week.
Yeah, that's interesting. Was it earnings related, or was it just
no? Earnings happened before the collapse on August 5th, which was kind of over here. So this is really just getting some attention now.
That's great. I mean, yeah, that's definitely something that I would put on my radar, especially since it's not earnings related. It's just momentum. It's
And good
institutions.
volume on a day that the market was pretty neutral.
Yeah. One thing I put on Friday, I put this in the community, CAVA, Kava Group.
Mm-hmm.
Now, this is
Restaurant stocks have been strong. We would make a note of those guys as well.
this is just a boring old restaurant stock, right? But look at the volume. It was on earnings, obviously, but the short float, I think, was a little over 10%. So I actually played a little bit of a fade on this one. So I did a counter trend trade on this one. I waited for it to reach that maximum. What I did was I did my VWAP strategy. I went to a 5-minute chart. Was about 10%, right? Something like that.
Just over 10.
Yeah. So to me, that's a short. That's not just a momentum earnings play. That's a short covering rally as well. So when those shorts are finished getting their margin calls, basically, that could be interesting. That could be something where you can fade. So I started to fade it on Friday because you could see the upper shadow that it had. From Friday's candle. I put it on a 5-minute chart. I looked at VWAP. It was above VWAP all day long, except for the very last. You see how it started to fade a little bit toward the end of the day. It never really broke VWAP, but it was tempting enough because it looked tired. You see how it kind of got tired. It was tempting enough to start to short it a little bit. So I have a put option out on that. And again, it's super speculative. I don't like doing these. It's about 2% of what I do. But when I see something like that, it kind of draws my attention a little bit too.
So speaking of those kinds of plays where it's not necessarily lining up perfectly, we've been talking every day this week about Wolf and the massive volume, and that's prior to earnings. So earnings came out over here. We started to notice this volume just expand dramatically heading into earnings. And again, the order flow is clearly to the downside. But it's a core part of what we do is paying attention to how the volume unfolds and where it's unfolding. And this is just such a perfect classic sign of accumulation. It's not necessarily heading in that direction yet, but right around $10 is when it started to happen. It stopped going down. Anytime you see a down move into a pause or a consolidation, and during that pause, there's heavy volume, and it's got to be noticeably heavy, not like 1 day or 1 hour. Like it's got to be noticeable across there. There's buying going on under the hood there, so to speak. That's what we used to call it on my trading firm. And this is such a good example, John, of what you mentioned before about how the old school traders would start to build a position. Like you're not getting in there with 5,000 shares because it's $10. You're putting a piece on for what Jesse Livermore called a probe or whatever language you want to use. But this is one of those trades where it's not technically perfect, but it's certainly interesting to get you to sit up and say, I'm gonna start paying attention to that because something is going on. You can't have that much volume without something going on. Yeah,
there's definitely accumulation going on there, and you can see it in the volume and just a slow, gradual increase in price. Because as an institutional trader, you pay a very close attention to that. You wait for the open, and you have to keep in mind you never want to be behind the VWAP curve. Like if something is drifting slowly higher, even if it's ever so slight, like that chart that you just showed, as an institutional trader, you're going to look really bad if you miss a day because you think maybe it'll pull back. The stock obviously has been in a crummy downtrend. So, you'd be inclined to maybe skip a day and to see if it does roll over without you. You know what I mean? But when you start to see it increase like that, that might mean there's multiple participants. And if that's the case, especially for a $10 stock, you do not want to miss out. The next thing you know, that thing is $15. You know what I mean? And then your boss is firing you. So what you want to do is just because you missed the whole thing. You know what I mean? You missed the whole idea. So there is that, especially for those cheaper stocks, you'll see that gradual participation, and it'll go up 50 cents, 25 cents, whatever it is, and it'll start to increase. That actually just validated what I was told when I had my firm and we had all those specialists come off the floor of the exchange. They were adamant. Like VWAP was a big deal, and their order flow, the order flow that they got from institutions, their number one job was to try and get it as close to VWAP as possible. But aside from that, is they said, well, that was important. It was actually more important to get the full position on than to get the exact price because they were trading for the next move or wherever they thought that stock was going. And anytime they tried to get cute to get as close to VWAP as possible at the expense of getting the position on, they actually lost order flow and lost clients because they actually didn't get the full position on because they were trying to trade
the order flow as at around VWAP as opposed to just getting it filled. And you just validated that. That's pretty interesting.
9 times out of 10, if I left an order with a specialist back in the old days, if I left an order with like, either the floor or I left them just even a sales trader on the sell side, like Morgan Stanley, Goldman Sachs, whatever. 9 times out of 10, if I said, use your discretion, if I use those words, like here's 1 million shares, I want you to target VWAP. That's like, that would be my language. And let's say 1 million shares was enough of an order where I knew they'd be finished that day. Like let's say it traded 20 million a day. So I knew 1 million share order, although a very large order, and it can move the price over the day, it should not move the price if you do it correctly. It's maybe 1/20th of the order size of the total volume. So when you say give an order, target VWAP but use your discretion, that basically gives that trader the latitude to, like what you said, maybe try to be cute. Try to find cheaper prices, try to see if there's a natural seller somewhere. 9 times out of 10, I would do that. My price would be lousier than VWAP because they would just not do it correctly.
Quite frankly, it's not their job to trade. It's their job to fill the orders.
Right. So like, I always tried to give them latitude and try to improve the price, but usually, VWAP is a very closely used guide because it just means that everybody was treated fairly. You got the right price and, everybody's happy,
So I actually heard that from, just to give everybody some context, the guy who happened to be in the office at that time, he was the specialist for Disney and Pfizer. So he had he was involved in the 80s and 90s, I would say, is when he was on the floor of the exchange. So he had some experience in there to give me that kind of context. He said that if I didn't fill it at a reasonable, he goes, I lost the account. He goes, they weren't sending me order flow after that.
Yeah, and as a specialist, you don't want that. You want to have the liquidity. That's the most important thing. So, yeah, you want to, sometimes you have to just pay up, or sometimes a specialist would have to stick their neck out a little bit.
So, John, obviously, I'm familiar with your background a little bit. I want to give everybody a little bit of your background for those of you that don't necessarily know you. We started to talk about that you worked for the French Warren Buffett. I mean, that's a pretty big headline. Can you give us a little insight on who he was and what that meant?
Wow. So, yeah, I was lucky enough to get a job pretty much right out of college. I struggled for the first year out of school because I was an accounting major. And, my first year, I wasn't sure if I wanted to go in the accounting direction. I really always had a passion for the markets and stuff like that. But I never really wanted to be in sales. I didn't think I'd be good like being a stockbroker, for instance. You know what I mean? So trading was definitely something I really had an interest in. So I was lucky enough to land a job at a French bank. And the French bank was the second largest in the world at the time, the second largest French bank in the world. And I was in their asset management department. So I was in the accounting department, in the asset management department, in the fund group. So they ran 2 mutual funds. They had some separately managed accounts. And the French Warren Buffett, his name was Jean-Marie Eveillard. He was, I think he's since retired. He's, he's still alive, but he was, he's pretty much retired now. But he followed Benjamin Graham, Warren Buffett. But his twist on things was back then he had a global spin on things. So Warren Buffett tends to be U.S. centric, you know what I mean, for the most part, especially in his early career. What Jean-Marie did was, what was interesting about his background was because he was a European and he was managing a U.S. fund, we were a global value fund. So we took Warren Buffett and Benjamin Graham's philosophy of value driven and we spun it into the whole world. So we were a go anywhere fund. So when I got onto the trading desk a couple of years later, I was trading not just in the U.S., but I was trading in Europe, Africa, Asia, Latin America, wherever there was value, he wanted to be involved. So that meant sometimes, obviously we talked about VWAP and, order flow, very illiquid securities, hard to trade securities. That was my specialty, where I would go in there and I would try to put together block trades, where I would try to find a seller and put together the best trade possible with the least amount of price impact as possible. That's the key, because you obviously don't want to move the price when you're not finished with your order. So that's kind of how I learned. That's kind of like how I grew up, basically.
Did you find internationally the accounting practices were similar in the sense that you could read one financial statement from a U.S. stock versus a financial statement from Brazil. I'm just using Brazil.
It got better. It got better later, but in the beginning, no. The accounting standards were different, and the analysts. I was never an analyst, but like the analysts in our group would have to take that into consideration. And sometimes the sell side, like Morgan Stanley, Goldman Sachs, the brokers would be able to translate the financial statements into GAAP, into generally accepted accounting principle statements. So they would help us out with that. So there are people that just that was what they did for a living, being able to decipher financial statements of other countries. But it's gotten more uniform in the last 10 years, 15 years.
So we got a couple of questions here. Harry saying stocks seem clingy, not much separation in the candle. I think that's a good observation. I think that with the holiday, with the 3-week rally, with all-time highs coming up, earnings season pretty much out of the way, I don't know that we're going to get anybody making big bets after a 3-week rally up at this level at this point. I think start working our way, like you said, into September, October, we probably will, but I don't think that's wrong. I actually think that's a good observation, which really means that you need to have your software set up right. Like we just pointed out, Zoom, you need to be on top of those ideas when they do unfold.
Yeah, I don't think it's, it's not like you could just take the week. I mean, if you want to take the week off, it's great, but there is enough stuff, like you said, going on that you can, especially since we're in this kind of contentious, election as well as geopolitical going on. There is potentially a lot of moves that could happen in the next couple of weeks.
I've actually had a lot of people, I think smartly asking me, is there an election trade or a sector that we could trade into the election? We did exhaustive research, and the answer is no. Absolutely after the election, though, because policies that come in completely can change, I think, industries more than sectors. Yeah. I'll give you, for example, solar. What last, election just literally launched solar stocks for, it was only for like 2 or 3 months, but policies that get discussed, again, we're not political here, just be super clear to everybody, this is just friends talking, but after the election, it makes sense to pay attention to what they say they're going to do, and then have a list of those industry groups after the election, because it could make a monster difference, right? Because they want to fulfill the promises right away.
Yeah, there's so many factors too that go into it, though. Also, you have to look at Congress, like, do they have Congress behind them? You know what I mean? So like if you have one president that gets elected, no matter who it is, and let's say their policy is whatever, right? Can they pass it through? What's the probability of it actually happening? You have to kind of look at that too. So it depends, but yeah, you generally solar and EV I'd watch, you know what I mean? And then, on the other side, you have oil, right? So those are the ones that kind of come to mind. But it's one of those things where what's the probability of it happening? You know what I mean? And there's so many other things that go into it. It's very hard to predict, very hard to do like an election trade. You know what I mean? I think also the fact that it's such a close election, if you look at the fact that it's basically 50-50 right now, I'm not a pollster. Again, we're not getting political, but if you have a higher probability outcome, then you can make better predictions in general. But right now it's so 50-50 that it's very hard, I think, to try to do that,
So again, not getting political or whatnot, we've been watching The West Wing a lot recently, right? And I actually found something out that I thought was fascinating. That obviously, again, keeping this friendly, the news that's out right now, there's such a divisive tone to whatever channel you happen to be watching on the news, where it's clearly bent one way or the other.
Right.
I didn't know until this week that it was actually Ronald Reagan who did away with the law that any news story that's getting reported, you had to report both sides of the story. So like you had to do a pro and a con on any story. So there was always again, for our age, a little bit more where you actually, when you were watching the news, you actually felt like you were watching the news being reported as opposed to promoted, for lack of a better way of putting it. I thought it was fascinating that it was actually Reagan who got rid of that, which kind of led to the polarizing news that we have today.
Yeah, I mean, I missed the Walter Cronkites, you know what I mean?
Yeah.
Tell me what's going on. Tell me both sides, But now you have to kind of try to find, you have to kind of decipher it yourself. And that's where I think the internet's getting more and more popular, obviously, right? The podcasts, you know what I mean? Those are obviously leaning in one direction or another too. But then sometimes you get like some nice commentary from different people where you get a nice opinion. You get you try to get both sides the best way you can, you know what I mean? I personally find Bloomberg to be pretty good. They're just a financial news organization.
Yeah, they're very dry. They're not cheerleaders, which is why I never listen to CNBC when I'm trading. I keep wireless.
Yeah, and then you have like the Financial Times. You have like there are others. Reuters. So they're out, but they're very dry. You know what I mean? If you're looking for entertainment, you don't want to go to these guys necessarily.
Yeah, you can even say that about websites as well. Like I get asked all the time where I'm like what I read every day. I have subscriptions, to everything, so I can be as informed as possible. But I have found Barron's to be very market neutral, but very good reporting.
Yeah, and you know what? If it's an opinion piece, it'll tell you. So this is an opinion piece. Like it's same thing with Bloomberg. There'll be political stuff on there, but it'll tell you, Bloomberg opinion. You know what I mean? So you know whether you know what it is at least. You know what I mean? So I like that. But yeah, it's been increasingly more difficult, and I think that definitely could create a bias, no matter what side of the aisle you're on. And you got to kind of you got to separate the cocktail talk from what's happening in the markets, right? So you might feel a certain way about an election, but that could actually affect your trading, and you don't want that to happen. You know what I mean? So it's very important to
you get a bias where you're not actually paying attention to what's happening. I've seen people lose a small fortune, not over politics, but over what they believed about the company. And Under Armour is actually one of those particular companies where I had somebody I traded with back in the mid 2010s, and the guy just absolutely loved it and got destroyed with his opinion.
Yeah, if you're trading what you like or a product that you use, that could be confirmation bias or different bias. You know what I mean? There's all kind. I mean, human beings, we're naturally, with information that we receive, we tend to have a natural bias sometimes, and you have to be very careful as a trader to kind of avoid that.
The only bias I've seen that I thought made sense, I had a trader in New York. The guy was a multi-million-dollar trader year after year after year, very volatile as a trader, but he's like, I'm bullish. I don't care about the other side of the market. Like he's like, my bias is bullish. I don't care what's going on. If a stock is going down $8, I'm getting the $1 bounce. Like that. Like he was so focused on, I'm only on the bullish side. And long term, I could see that kind of makes sense because unless I actually was thinking about this just recently, the bearish side of the market, when it has a macroeconomic backdrop to it, tends to have much better consistent bearish moves. But if it's just a quarter or a news cycle, I have found that we haven't had the same follow through longer term on the bearish side. And I don't have statistics on that, but in my experience, it seems that way.
Yeah, usually when a bearish move is financial related.
For example, quantitative easing being done.
Yeah, that could be one. Also, just recession or financial crisis. Even before that, if you all remember the Asian crisis, there was always a crisis. So like whenever there's a crisis, but the crisis involves financial, it usually tends to last longer and be more predictable to the downside. But when you have just a cyclical pullback like we got a couple weeks ago, like rate related stuff, like concern about a recession, blah, 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 that tends to be by the dip. You know what I mean? Over time.
So Gurpreet's asking about CVNA. This is actually an interesting chart because there's actually two things going on here. This is a pretty big level, right? Obviously going back to 2022. The interesting thing, so I agree with you, Gurpreet, it's actually at that level now where it's kind of a major resistance where it hung out here for a couple of months. But I just want to point to something that I don't normally put a lot of focus on, but John just brought it up before, and it warrants a discussion here. For a while during this rally for CVNA, and especially when we were looking to buy, we were pretty aggressive down here when it was in the 10s, and this first rally here. The short float at that point was almost 30, which is a giant number. And to give you some context,
it's 13% now. Yeah.
Yeah, exactly. That's my point. It got cut in half. Mm-hmm. So the short side of the market, 13.5 is still up there. Apple, I think, is like 1, or just to give some context or whatnot. But
30 is crazy. Yeah, 30 is like, okay, it's really heavily shorted.
Yeah, and we saw those bursts. Like when you get a little bit of a burst through a level, shorts have to cover because they're basically screwed. Buying back a short means you're buying back the stock, and then buyers, and that's why we get these fast spikes. But because of the short float being cut in half, we're trading a little bit differently now. I absolutely would I be watching this, and I think we talked about it over this 160, 165 level. Next level beyond that is here, which is $80 above that. So there is some, I would absolutely be paying attention to the stock through that 150, 155 level.
Yeah, I think it'll take some time to like work through some resistance. It might pull back and make its way up there. So for me on the option side, that would be a fantastic candidate for a poor man's covered call, where you just go out a whole year, you buy the call options, for a whole year. You obviously have a slow burning candle, right? You have a little bit of theta decay, you know what I mean? But you can sell calls every month against it, way offsetting the theta decay.
So something that's super interesting that like my eye just kind of like goes to it. And this is not necessarily something that's like taught or whatnot, but we're going to do it right now anyway, is if you look at this stock and you look how this stock actually moves, and this is more from a mindset perspective and managing the trade, it looks like it moves in 2-week increments and then goes sideways for 6.
Mm-hmm.
Like you need to know that. You need to pay attention to that. You can't get frustrated out of a trade that's working. I mean, how obvious, like it pops and then goes sideways for a month and a half.
Yeah, it kind of looks like that's what's going to happen next.
Exactly. That's exactly my point.
So, so for me, if I'm going to do something, I would throw on something longer dated that could sit through some time decay. That's why I mentioned some sort of diagonal, like a poor man's covered call is like your ultimate diagonal where you're constantly selling premium against your long position. And that allows you to sit through a trade for months and still collect money, a premium while you wait for it to potentially move higher.
So I think you just answered LJ's question as he was typing that in the money.
It depends. So yeah, always in the money, but at the money or in the money. So if you anticipate volatility to pick up, depending on the vol environment right now, I'd be comfortable doing at the money on Carvana going out a whole year. But if you want a more equity-like, not return, but you want like equity-like movement where it's not, wreaking havoc on your P&L all day long because you have it out so long and it's just sitting there, then you could do in the money with maybe a 75 or an 80 delta, something very in the money. So your underlying leap or your long dated option won't move around that much.
Any ideas heading into next week? I can tell you right now, I think the biggest thing is mapping out mentally for next week, which is essentially, I think we need to be a lot more stock specific next week because the big picture is kind of known at this point, right? We know what's going on with the Fed. Even though we have big economic data coming out this week, I don't think it's going to be unless it's a shocking number, which at this point I don't anticipate that, but you never know. So the GDP number, the PCE number coming out on Thursday and Friday, not necessarily something to be fearful of, or you still need to know what you expect. But I think again, the NVIDIA earnings on Wednesday after the close could turn into some great semiconductor trading. Either way, Wednesday, Thursday, Friday more so because it's after hours. And then looking for some follow through this week on individual stocks that had earnings. So I'm going to be very, very stock specific this week.
Yeah, I have a couple up my sleeve I'm looking at. For one, I like DuPont DD in basic materials. That one looks like it wants to maybe head up to the ultimate high there. And then also even Caterpillar just broke out of a little bit of a range. And then let's see. I'm trying to look at basic materials because I already have like UNP, I have Ally in the financial space from last week that are doing okay. CNM also. So basically I'm trying to add basic materials because that was like one of the sectors that kind of poked out a little bit on me, so that, these are names that I'm kind of like either in or already in. And then let's see, Fastenal, FAST. And so that looks like it's poked up. I'm just like, again, not expecting miracles out of this thing, just to reach that resistance area, and also, what else was that? SAVA, SAVA in healthcare.
That gets talked a lot about in the day trading community.
Yeah, that one has a nice high base, so that's basing now. So again, for it to push up to that high, again, not expecting it to break out or go crazy, but just, these are kind of small little trades to put on for the week. You know what I mean?
So I want to throw a stock up here, John, and I want to get your thought process on what happened behind the scenes here. So GEV, with this breakout above this big resistance, pausing here for a while, to me looking like a fantastic candidate. It's going to follow through. And
Yep.
we get this implosion that then closes at the highs.
That's some candle. Wowzers. Yeah. So that just shows that nobody wants to, it tried to test, and buyers stepped on in. You know what I mean? They saw it as a buying opportunity. That shows positive price action. You know what I mean? Especially, I don't know if it was news. Was it earnings? There's something going on there. Was it?
Just related to the sector, not anything in particular.
Yeah, I mean, that just shows real buying interest. You know what I mean? And that's what you want to see. You know what I mean? A little scary probably why it's happening, but the fact that buyers stepped in shows that they're willing to protect the price, and that's positive.
So I want to throw this out there as a lesson for everybody. We kind of ended on this: is if you took that trade and it got above that breakout level and everything looked great, especially here where it starts to look like it's all right, finally it's going right. Don't give up on the idea, because you can't have that kind of price action on that kind of volume without somebody having attention on it.
Right.
So if you took a loss on this particular idea, I would revisit it again this week.
Yeah, I agree 100%. I think anyone who would have bought it the day before on that mild little pop it had there, you know what I mean? They'd be disappointed, obviously. Probably would have gotten stopped out.
Yeah.
But to see it, I know it could be frustrating. I know what you're saying. I would be tearing whatever little hair I have left. I'd be very, I'd be very frustrated. But the fact that you have to kind of dust yourself off and say, hey, listen, someone came in or something or some institution came in and bought this thing right back to where it was. So it could be another opportunity for sure. You have to kind of just one trade loss. You have to kind of shake it off. It should not affect your mental bias for the next trade, and that's a very difficult thing to do.
It does. That's why I brought it up. I know a lot of people who are looking at this idea, and I want to make sure that we can kind of give them a mental reset heading into the weekend.
Yeah, because they might be like, I never want to look at this thing again.
Right. Exactly.
If you do that and you trade for 20 years, you'll have nothing left.
Oh, that's funny. So again, with some ideas from this week bleeding into next week, some of the retail stocks reported and exploded to the upside. So again, don't forget about what happened this week, next week. Start to make a list of stocks that reported and had some tradable volatility. So I'm also watching Target this week. TJ Maxx had a big gap up and going sideways. So keep some of these ideas on your radar for follow through momentum this week that we might not have gotten last week after the bullish gap. So make a list of those as well.
Absolutely. And I think, as far as, financials, industrials still look great. Healthcare still looks great. And now basic materials. If you're looking for bears, I know there was good price action on Friday, but energy is still longer term, probably the weakest sector out of the group for now.
Look at the depth of financial here. That's crazy, but not out of the blue because of what's going on with interest rates.
Yeah. So there's definitely, when you have 9 out of 10 sectors positive on the week, you have to kind of take notice. The breadth is getting better. We probably will push towards those highs, and maybe we'll roll back over again, but we'll see. But right now you have to lean bullish, I would say.
I agree. All right, John, thank you so much for your time, everybody. Awesome for being here with us on Saturday. Really, really appreciate it. We'll get the replay and all the research out to everybody as soon as possible. And again, obviously, next weekend is Labor Day weekend. We'll give everybody email updates on what's going on next weekend as well. All right. Thank you so much, everybody. John, thank you for your time. Always appreciate it.
Absolutely. Have a wonderful weekend, everybody. Take care.
Bye-bye.